Good morning, everybody. October 28th, 2024. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. Presentation you are seeing and or hearing has been prepared by us for use with you, whether you are an individual investor, an institutional investor, or a financial advisor. You are all expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment advice. There's no tax advice. There's certainly no recommendations for the purchase or sale of any securities. Everything is strictly for informational purposes, and its accuracy, adequacy, or completeness cannot be guaranteed. Well, we had a rare down week in equity prices, especially since the Fed started cutting short-term interest rates. We've seen, a nice rally in equities, new all-time highs, maybe a week or two ago. And so we gave back a little bit. That's good. That's normal. That's healthy. The S&P down about 1% on the week. Mid-cap and small-cap stocks down quite a bit more, about 3%. But as I'm speaking this morning, Monday morning, it's about 8:40 Pacific. Small-cap stocks, Russell 2000, up about 1.3% already on the morning. So wiping out, essentially almost half of that loss last week. International markets declined as well. Fixed income markets declined. You can see the aggregate bond index down about 0.9%. This is on higher inflation expectations. So if the Fed is actively cutting rates and has begun a rate cutting cycle, you might think interest rates would be going down. Instead, bond prices are going down because the markets are looking through the rate cuts and are concerned about inflation going forward. High yield also lost about 0.4%. That's not, high yield spreads haven't widened. I'm not worried there yet. And interestingly, I put together this week, this is a graph of the U.S. Treasury's curve before and after the Fed started cutting rates. So this gold line you see here, this is the inverted U.S. Treasury yield curve on September 16th, the close on September 16th. Remember, the Fed started its meeting on the 17th and then on the 18th announced the 50 basis point rate cut. At the time, I thought it was premature given inflationary pressure in the economy. And interestingly, this is the result. Here's the curve today. With the exception of 6 months, or really less than 6 months, you got to go about 4 months, every other time frame on the rate curve, those that are set by the free and unfettered market, amalgamating the expectations of thousands and thousands or hundreds of thousands of investors, every single one is higher. The benchmark 10-year Treasury, you can see here, was at 360. It is now at 425. What is lower? Just the very, very short end of the curve, because the Fed funds is an overnight rate that the Fed can control legally and does and has, and reduced it by 50 basis points. So that sent the yield on, say, 1 and 3 and even almost 6-month securities a little bit lower. Everything else on that curve is higher than it was. And these higher rates reflect the expectations for inflation, because bond investors want to earn a premium over inflation. If they expect inflation to go higher, they need a higher interest rate on the bonds they invest in. Therefore, that curve is continually shifted higher. And of course, the Fed is continuing to state they're going to keep bringing this very, very short-term rate down. So down here, these little bars represent the amount of increase. Interestingly, though, stock market's done pretty well since that time, despite higher interest rates. Take a look here. Here is that 360 yield on the U.S. 10-year Treasury, the green line. And look at it here, 426. What a sharp rise. This is a rise in inflation expectations. And the earnings yield, that's the inverse of the PE of the S&P 500. So the EP, if you will, earnings divided by price. The earnings yield of the S&P 500 is now down to 377. That's very low. That represents high valuation. And now your alternative to stocks, right? You have a choice, stocks or bonds and other things, but for the most part, stocks and bonds. If you buy 10-year treasuries today, you get 4.26% for 10 years. But if you're concerned that inflation will eat into that 10%, then you say, well, I'll take a lower, much lower earnings yield for stocks, 377, in the hopes that they'll be able to outperform those earnings estimates because inflation is raising the prices they'll receive for their goods, raising the nominal value of the earnings that they will report. Or you could look at this and just say, hey, stocks are overvalued and bonds are undervalued. That's a more traditional way to look at this exact graph. Getting into economic data from last week, we start out with a couple of data points on residential real estate. Existing home sales for the month of September expected to go up 0.5%. We're down 1%. After a 2% decline in August, 3.5% lower the pace than it was a year ago. And it really is a 14-year low. Well, 14 years ago was 2010. That was coming out of the global financial crisis. So if you're in that industry, you're hurting. We know you're hurting. And it's actually one of the reasons I think that the Fed is looking at it saying, hey, if we cut rates, we might help the people in that industry. The problem is they can only control that short-term rate unless they go and conduct open market operations and actually buy bonds. There's no way they'd be doing that right now because that would be the equivalent of printing money. But 30-year mortgages are largely based off the 10-year treasury. And I just showed you that that's gone from the 360 level to the 425 level in a very short period of time. New home sales actually continuing to pick up a little bit. September new home sales gained 4% after falling 2.3 in August. They're 6.3% higher than a year ago. So why the difference or the delta between the existing and the new? Well, what's happening in the new home side is the builders, the business people creating the product are getting creative and finding ways to get buyers to qualify. And the way they're doing that is they're buying down the rate. So, for example, if you raise the price a little bit, sounds like inflation, and then buy down the rate, you can get a lower payment for those buyers. So that's what they're doing. So making new home sales a little more attractive, buyer incentive programs helping out. In the long run, I don't think it makes a whole lot of difference, but it gets buyers qualified for the debt financing. And they don't, rather than having a 7% mortgage, they might have a 5.5% mortgage, but they paid a lot more for the house. So it's 6 of one, half dozen of another. We got weekly initial claims for unemployment last week. And if you remember, they had spiked a couple weeks ago. And I had said, I think that's just purely related to initial claims related to hurricane layoffs in North Carolina, Georgia, Tennessee, Florida, etc. Weekly jobs claims last week fell from 242 right back down to 227, well below the estimate. And again, now it's attributed to, coming off the spike. Continuing claims for unemployment up a little bit, but basically still solidly under that 2 million level. We also got October flash readings. These are not the final readings. These are called the flash because the month isn't over. S&P Global, we get services and manufacturing. This one is manufacturing. Rose a little bit, but still contracted. So the number, if it's below 50, means it declined. And then we have it's a relative scale. So 47.3 to 47.8, the rate of decline slowed. It was better than expected. 15% of the U.S. economy approximately is manufacturing. I think it's a big part of the current political campaign, particularly on the Trump side, to bring more manufacturing into or back to the U.S. Through the use of tariff policy, which would make manufacturing rise theoretically if that were to happen. 85% of the U.S. economy, though, is services, and that just continues to be booming, for lack of a better term. Rose slightly from 55.2 to 55.3, in line with the estimate of 55. But you see, you got the 1, 2, 3, 4, 5, 6 months here at this 55 level. 55 level is considered fairly robust. This is a very solid, strong economy. If you get over, getting well above 55, you're really talking about it being almost inflationary for the economy. September durable goods fell at 0.8%, kind of in line with expectations, second month in a row. You can see it's a volatile series. There's no trend to draw from that 2 straight months. Commercial airline woes are a problem. There's weighing on orders, taking out the transportation. They rose 0.4%. So really Nothing particularly exciting or out of the ordinary there. Consumer sentiment out of the University of Michigan. We get the Conference Board's reading, and then we get the University of Michigan's reading. For October, Michigan rose from 70.1 to 70.5, a little bit above expectations. I think we've seen some gasoline price drops that likely helped. But you can see overall still at a very, very low level since about the beginning of 2020, middle of 2020. You want to say it's been kind of on a decline. We had kind of that boom time prior to COVID. COVID came, change of administrations, change of tax policy, regulatory policy, for the most part have had some impacts there. And clearly the most significant impact would be the inflationary consumer price situation. Earnings are coming in fantastic. 183 out of 500 S&P 500 companies have reported. 140 of those, that's a pretty big number. It's a pretty big percentage, have beat. The average surprise among all companies is about 6%, beating the analyst expectations. But this week, I would say, is probably the biggest. Even though we've had a lot of names, a lot of market cap, and a lot of industries, this market is increasingly all about the Magnificent Seven, the Mag Seven. And this week, 5 of those names will report. Tomorrow, we've got Alphabet or Google. We've got Facebook or Meta and Microsoft on Wednesday, Amazon and Apple on Thursday. So this is a big week. Those will be what's driving the market. And as we're sitting here Monday morning, I see the NASDAQ trading higher, the Mag 7 index trading higher. And I think all of that is on expectations of very strong earnings out of these very important names. Obviously, we are getting closer and closer to no longer talking about the election, assuming it goes well, it's settled, et cetera, next week when it happens. This is the current Real Clear Politics electoral map with no toss-ups. So they take the close states and say, well, if they're close on the polls, we're going to color them red or blue. They're showing Trump-Vance winning at about 312 electoral votes, Harris-Walz at about 226. It has changed a lot since the debate, where it was really favoring the Harris-Walz ticket. Then I saw it as high as like 319 or 318 for Trump-Vance ticket, and since backed off just a little bit. The other place I like to look to see what's happening there is in the betting markets, and those indices, believe it or not, come through on my Bloomberg terminal. The white line here represents Trump, and the blue, this was Harris. So Harris never had anything until the party replaced Joseph Biden with Vice President Harris on the ticket. She came out. There was a debate, if you recall. She seemed to win the debate, and the odds were in favor. Since then, however, since really the beginning of the month, things have turned significantly for the Trump-Vance campaign. Now up to 61% on the betting markets. Harris at 44%. You realize they don't add up to 100. That's the spread that the bookies make. But you can see here, this is a big gap. And so last week I said it seems more likely than not at this point, unless there's some crazy October surprise between now and then, or the polls are completely wrong, or the betting markets are completely wrong. But the markets and the positioning of players in the markets seem to suggest that we will have a Trump victory and all of the economic things that go with that. I'd say the biggest of those right now is this sort of growing acceptance or understanding that perhaps a Trump-Vance ticket is not a bunch of deficit financed fiscal spending. And that was kind of the narrative we saw over the weekend. Our chairman, Howard Lutnick, talking about it, that no, we've got this Department of Government Efficiency. We're going to use tariffs when appropriate, not unilaterally, but when other countries are not, when they erect barriers to our trade, whether tariff or other, we will do the same rather than sort of letting the deficits happen, and that the tariff revenue combined with the spending efficiencies could lead us to less deficit financed fiscal spending. And that is sort of a growing narrative that we're seeing. That would be positive for our portfolios. Obviously, tackling the biggest issue, the biggest economic issue, in my opinion, for investors is the debt and deficit. And it is incredibly important to our ability to invest and grow portfolios over time. In terms of economic data, we got quite a bit this week, actually. Nothing big today on Monday, but we've got home price data on Tuesday, along with JOLTS or job openings. That's looking to be about 7.9 million, along with consumer confidence. Wednesday, the ADP employment report for October. Consensus is we added about 100,000 jobs. Q3 GDP coming in at 3%. Pending home sales. Then we get moving on Thursday, jobless claims, employment costs, personal income and spending, PCE price index. This is big. If this were to come in lower, that would be welcome news to markets. I don't think that's likely to happen. Chicago PMI, the big Bureau of Labor Statistics report, that's the BLS, the jobs report. Average hourly earnings are part of that. Employment rates part of that. Then we've got the final readings on manufacturing for both S&P and ISM, construction spending, and the Ward's auto sales for October. Thanks for tuning in, everybody. I always enjoy doing this every Monday morning. We like to make the complex and complicated simple and sensical. Thank you, and I will be back in 1 week.